Imagine waking up one day to find out that the world as you know it is on the brink of economic collapse. The stock market plummeting, banks collapsing, and millions of people losing their jobs, homes, and life savings. This was not a scene from a dystopian movie, but the reality of the 2000s financial crisis. The biggest financial scandal of the 21st century began in the mid-2000s when banks started giving out risky mortgages to people who couldn't afford them. These subprime loans were then bundled into complex financial products called mortgage-backed securities, which were sold to investors around the world. The problem was that these securities were based on a house of cards. If even one borrower defaulted on their loan, it could trigger a chain reaction that would bring down the entire system. In 2008, the bubble burst and the financial crisis hit with full force. Lehman Brothers, one of the largest investment banks in the world, filed for bankruptcy, causing global stock markets to crash. Banks stopped lending to each other, and credit froze up, leading to a deep recession that affected millions of people worldwide. At the heart of this crisis was a culture of greed and recklessness. Bankers were incentivized to take on more risk to make bigger profits, with little regard for the consequences. The financial system had become so complex and interconnected that no one could fully understand or control it. But who was responsible for this mess? Was it the bankers who took excessive risks? The regulators who failed to enforce adequate safeguards? Or the politicians who pushed for deregulation and turned a blind eye to the warning signs? These are the questions that The Money Trail will explore as we delve into the biggest financial scandal of the 2000s. The roots of this financial crisis can be traced back to the late 1990s and early 2000s when a wave of deregulation swept across the United States. Politicians, swayed by powerful banking lobbies and free market ideologues, dismantled crucial safeguards that had been put in place after the Great Depression to prevent another economic catastrophe. One key moment came in 1999 when President Bill Clinton signed the Gramm-Leach-Bliley Act, which repealed part of the Glass-Steagall Act of 1933. This allowed commercial banks, investment banks, securities firms, and insurance companies to merge, creating financial institutions that were now too big to fail. The idea was to foster competition and innovation, but in reality, it set the stage for rampant speculation and risk-taking. In the years that followed, Wall Street giants like Citigroup, JP Chase, and Goldman Sachs took advantage of this new landscape by developing complex financial products known as mortgage-backed securities. These instruments bundled individual home loans into large packages, which were then sold to investors around the world. The problem was that many of these MBS contained subprime mortgages, high-risk loans given to borrowers with poor credit histories or low income levels. As housing prices began to rise in the early 2000s, it seemed like a winning strategy. Banks made huge profits from originating and selling these risky mortgages, while investors clamored for a piece of the action. But when the housing bubble burst in 2007, everything came crashing down. Suddenly, there were millions of homeowners unable to pay their bills, leaving banks with billions of dollars in bad loans. But who should have been watching over this dangerous game? That responsibility fell on regulatory agencies like the Securities and Exchange Commission and the Office of Thrift Supervision. However, these organizations were often underfunded, understaffed, and outgunned by the very institutions they were supposed to regulate. In some cases, regulators even seemed to be colluding with the banks. For example, between 2004 and 2007, the OTS granted its largest subsidiary, IndyMac Bank, permission to use riskier lending practices, despite warnings from within the agency about the potential consequences. So as we follow the money trail, it becomes clear that the big